Why do you believe this is still the right approach to take?
Because I'll miss on the huge losses when those happen. The growth doesn't justify the valuation expansion. As long as the party is going, everybody's happy, there is a chance that the party might stop. And that's a place where I don't want to be. I look at the fundamentals and slow and steady, I keep on compounding no matter what the market does.
Hello and welcome to Wealthion. I'm Maggie Lake, and joining us today to talk about how a value investor can find opportunity in this market is Sven Carlin of Modern Value Investing with Sven Carlin, which airs on YouTube. Hi, Sven. Welcome to Wealthion.
Thank you. Happy to be here.
And just a reminder before we jump in, if you have any questions about your investment strategy, you can get a free portfolio review from an advisor in the Wealthion network. Just click on the link in the description or head over to wealthion.com/free. So Sven, before we talk about specifics about opportunity and risk, I just thought we might start with the concept of value investing itself, because I think it's fair to say it's sort of fallen out of favor in recent years with so much of the action and frankly, the huge gains really centered around these big momentum, large cap tech stocks. Why do you believe this is still the right approach to take?
Because I'll miss on the huge losses when those happen.
Okay, so you think this is not, something hasn't fundamentally changed in the market in terms of how it functions. You just think this is a sort of cycle we're in.
I'm not there to predict. So, for example, value investing is about avoiding risk first and then getting returns from fundamentals. The S&P 500 over the last 7 years did 15% per year. With my portfolio, I did equally. The only difference is the S&P has a P ratio of 30. My portfolio has a price to earnings ratio of 10. I have 5-6% dividend yields. So whatever happens with the market, I want to get my returns from fundamentals, cash flows, dividends, buybacks, and not expansion in valuation. The P ratio of the S&P 500 10 years ago was below 20. Now it is above 30. So if you look at the market, more than 50% of the gains is just a valuation expansion. And everyone is looking at the forward projected expected earnings. But if you look at real earnings, the growth doesn't justify the valuation expansion. And as long as the party is going, everybody's happy, there is a chance that the party might stop. And that's a place where I don't want to be.
Yeah, I mean, I think that there are a lot of folks who are concerned. But what are you seeing? You know, we are sitting at these record highs. So from your sort of value perspective, what are you seeing when you look at the U.S. stock market? What sort of characteristics suggest that this is going to end badly?
Well, I cannot know that this is going to end badly. I'm not here to predict. I just see a dividend yield of 1.2%. Which is nothing compared to the historical yield of 4%. And yes, the stock market did great, but on completely different fundamentals in history. And there could be, now they are predicting as stocks go higher, the expectations about the stock market go higher and higher. Yesterday, I heard someone saying the S&P will be at 9,000 points by the end of 2026. And given the situation, that is extremely possible. But I know that there are these long-term cycles and the 2000s, the 1970s, where you get no gains for a decade or 2 decades. And with a dividend yield of 1%, I just don't want to be on that side of the bet.
So when you look at something like tech stocks, and this is something that comes up when you challenge people about the sort of momentum nature of this and point out some of the things you just said, they say, well, okay, you say it's an AI bubble, but and it seems the valuation seems so stretched, but these companies are making real revenue. There's real money coming in. Which, if people are thinking about value investing, that matters, right?
Sure.
How do you approach that, especially when you're looking at these AI stocks?
So I am a customer of Microsoft, of Amazon, of Google, of all the companies there, and I really like their products, and those are extremely valuable and wonderful businesses. Nobody can argue about the great businesses those are. On the value investing perspective, there is always this risk and reward. When I think it was 2-3 years ago, Amazon was trading at 1 trillion. Facebook was at 10% of where it is now. Google was even cheaper. And then we always look at that risk and reward. If Amazon would be trading now at 1 trillion, I would buy it. At 3 trillion, it's just a matter of price. So what am I getting for the price I am paying? And now I see a lot of momentum. It can go higher. Everything is great. But I'll look again when perhaps the next recession comes. I will look again at those names and see whether there is value. As long as I can find other things that I like perhaps better, or not better businesses, but at a better price and that give me more certainty when it comes to returns, then I'm happy owning the boring stocks compared to the momentum stocks.
Yeah, I think that's going to resonate with a lot of people because you're not sort of taking a position that these stocks don't have great businesses. This is really just operating on a framework and being very disciplined on that framework.
Yes,
Price
yes.
exceeds something you're comfortable, it's just not worth chasing for you. So how do you approach the situation we're in right now, given that clearly some of these stocks do not fit in your framework? Are you looking to actively put cash to work in some other areas where you see opportunity? And we'll talk about where they are. Or is this a period where you feel like the risk is so high that you actually need to hold cash? How should people be thinking about cash versus actively investing in this environment?
Depends on the opportunity. For example, one of the businesses I own is Amsterdam Commodities, which is a Dutch spice trading business. They have 200 years of history. They source the spices from all over the world, nuts, tea, things like that. And then they sell it across Europe, the States, organic, things like that. So such a boring business. Nobody is watching that, has a market cap of around 800 million. And it pays a dividend yield of 6%, and earnings over the last 10 years have been growing at 8% per year. And the projections are that it will continue to do so. A little bit of food inflation, it's defensive. No matter what happens, we are likely going to keep eating if AI doesn't solve that problem too. Some of us a little bit less, some of us more. But it's such a defensive, relatively cheap stock that I prefer having that one rather than sitting in cash, because cash, if we talk about cash, then over the long term, we are certain to lose money.
This October, Wealthion's putting the spotlight on silver with expert interviews, deep analysis, and a special in-depth report from our partners at SCP Resource Finance. To receive this report and other exclusive benefits, you can sign up to become an accredited investor with Wealthion at wealthion.com/accredited, or by finding the link in the description below. Speaking of silver, Wealthion will be on the ground in Toronto for the SCP Resource Finance Second Global Silver Conference, happening on Thursday, October 23rd. Legendary investor Eric Sprott headlines the event alongside 15 silver mining companies presenting their top projects. It's a must-attend for anyone serious about investing in silver. Tickets, both in person and virtual, are now available. Find out more in the description below. Yes, this is why I asked this, because there's so much conversation about fiat currencies and the devaluation and some of the debt problems we have. So it sounds like you don't have if possible, if you're able to find the opportunities, it sounds like you'd rather not have much cash at all. Is that fair to say?
I have very little cash, because as long as I can find opportunities, and that's what I do. I'm practically a researcher. I constantly look at things, analyze things. As long as I can find these things, then I'm happy owning businesses. just an example, Warren Buffett is all in cash, but a business that has a market cap below 100 billion doesn't move the needle for him. So I don't think he's looking into my area. Therefore, if I'm not competing with Buffett, I can still find something.
That's exactly what I had in mind when you were asking about that, because a lot of people look at, Berkshire still as the benchmark for sort of value investing. And it's made a lot of headlines that they've been raising cash. So that's exactly what was on my mind. So you're just more nimble and looking to be actively invested. So you mentioned that one company. Are there sectors that you like, or are you much more picking individual stocks? How are you, where do you see the opportunity? Right
I
now?
usually follow a lot of sectors and then look at the sector that is, let's say, with a negative sentiment, and I try to find fundamental values. For example, one of the terrible sectors now is the chemical sector, the Dow company and things like that. But, for example, if there is a recession next year, that will look even uglier. So there I say, okay, if there is too much risk still, despite everything looking cheap, and they have been over investing for the last, let's say, 2-3 years. So it will take 2-3 years to, let's say, wash that out. And then we just wait for low risk, high reward opportunities. And food is also relatively cheap now. So everyone is switching towards tech and AI, and they always forget something from that perspective. So boring companies, there are some in Asia, some in Europe, some in the States that give fundamental returns no matter what happens with the economy, with this or that.
One thing I hear a lot when you have this conversation about value versus, say, someone who is maybe looking more toward growth or has more of a growth perspective is, they'll say, well, they're cheap for a reason, right? Just because they're cheap isn't a reason to buy something. So talk to me a little bit about that concept. How do you make a determination that, yeah, something's cheap, but that doesn't mean I want to purchase it? What are some of the sort of, check marks you put to say, okay, wait, now this is interesting? How do you view that?
So the definition of value investing from an academic perspective is low price earnings and low price to book. That would be standard value investing. However, if I look at 20 businesses that have those characteristics, I am not a general value index investor that I buy them all. I try to analyze those businesses, and then from those 20, or even 100, then I select one that might be interesting. And so I form a list that I have been following for a decade now and carefully select those businesses when the opportunity knocks.
Yeah. So you have a sort of watch list going of companies this all sounds very familiar to me, but very old school, if you will. This is how research analysts used to do it, right? How people constructed portfolios. Do you care about management?
Well, management, you always look at if what they have been saying 5-7 years ago still holds. And just as you managed old hat and old fashioned, yesterday I was reading Peter Lynch, One Up on Wall Street. This was published, I think, 2000 edition. And he just comments on all these internet stocks and how great they are and how it will change the world and everything, but how he will remain old fashioned. I think that's in the introduction. So also that works because fundamentals work whatever happens forever, and everything else works until it doesn't. So that's it.
Yeah. How do you feel about, and do you use ETFs and index funds? Because this is one of the things in my mind that's really changed. When I first started out, talking to folks like you and reporting on markets and investing, it was really teams of people doing deep research, really understanding the company, visiting the companies, really, that really knowing the balance sheet inside and out. And we've shifted to a much more passive universe where ETFs, for all the benefits, have made it easier to just not have to choose the winner, but pick a basket of a stock. How do you feel about that? Is there a place for them? Do you avoid them?
I personally avoid them because it's mindless investing. They have some strategies or weighted or something. There are even value ETFs, but whenever I look at that, they just threw something, package it, and it's great marketing. I think the ETF industry has done the most wonderful marketing activity in the financial world. They get their fees, they collect their money, invest passively. And okay, for someone that is good, the fees are ridiculously low for an S&P 500 ETF, which is a benefit. But you will always get just the average with ETFs. And I'm not doing so much work just to be average. Just an example, now ski season will start, and I have looked, I think, a few days ago at Vail Resorts. I have published a video, and then out of the first 10 comments, 6 were about the bad customer service of users. And then, okay, that's also something that you don't get in an ETF or things like that. And then you say, okay, bad customer service, negative sentiment, which means that they might not turn to growth. And then you say, okay, a little bit more risk, and so you weigh it, compare it to other things. So I personally, I strive for being better than the average.
What are some of the other areas that you have on your watch list? Because I feel like outside tech has sort of been hoovering up all of the interest and momentum, and there are a lot of sectors that have sort of been left for dead. People comment and ask about energy. They ask about healthcare. You know, there are a lot of sectors that seem like they're hurting. What's on your watch list?
Volatility, for example. There are businesses that strive on higher volatility. And for the past few years, the VIX index has been down in the toilet. Nobody expects any shocks. And therefore, these businesses that trade on volatility, they, when and if all these bubbles or recessions or things start to revert, or the unsustainability of the current environment shows up, these businesses will gain a lot.
So are they financial businesses? Are you talking about
Like
financial?
money makers, market makers, or things like that. Yeah. That's
Yeah.
also a hidden opportunity in the current market.
Yeah. What about uh international versus US? Are you thinking about things from a geographical point of view?
Wherever I can find value. The US for now is the most expensive market in the world. I think the market capitalization is 65% of the world. Of course, there are the best businesses. China was relatively cheap up to 6 months ago. Now everything I had in China has doubled in the last 6 months. So I have trimmed that. But still, you can always find around if you look into places, but you really have to know well your international investments.
Yeah.
But
I was
given
going to
what has
ask you,
happened with the
how do you deal with the political risk, the geopolitical issue, currency issues? Like, how do you think about that if you're, because obviously they're going to be cheaper than US equities right now, many of them, but I've heard people have issues. Like Europe's a great example. How do you think about Europe? Because clearly from a price perspective, there's going to be opportunity, but then a lot of people point out a lot of issues about governance and bureaucracy and regulation, and for them then that becomes the reason they're cheap, not an opportunity.
Yeah, for me it's easy because I'm from Europe, so that's easier to understand, but that is correct. I would prefer an American, all else equal, an American business should do better than a European business because it's still easier. And let's say, especially if more deregulation comes in the States, it's easier to do business in the States than in Europe. However, there are always these smaller businesses that are more nimble, that operate globally. Then you sometimes you find businesses that have operations just in the States but are traded only in Europe, and therefore those are cheaper. So it's always about looking into those details that the market might be overlooking.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com. The other sort of question I have when you're building framework is, what about size of company? So I feel like when you're looking at neglected areas, there's been a lot of people, or there have been a lot of people who've been looking at small caps and saying, well, they've been underperforming so long, it's finally going to be their chance. And if we get interest rates that are lowered in the US, maybe we see a breakout, but that has been a disappointing place to operate. And it just hasn't happened. Do you consider small cap stocks, or do you prefer to stay farther up the food chain in terms of capitalization? Do you have a preference?
At the current levels, I prefer to go look under 20 billion market capitalization because nobody's looking. There are conference calls that I'm following. It's a 10 billion business and there are no analysts asking questions because everyone is focused on the Apples, on the Googles. And these businesses, they have 20, 30 billion of revenue and no one asks questions. That's crazy. However, on the small caps, I looked at the index, I think about 2 years ago, and I start with the ACE and I pass all the 3,000 Russell companies. And it was very hard to find value. So underperformance might be also a reason, because I remember a while ago, those were expensive from a relative perspective. So it's always about looking at those fundamentals and compare them to the price.
Yeah. Do you what is your sort of fundamental outlook for the global economy and for interest rates, and how much does that influence what's on your list right now?
I think that if you look at things, Asia is still booming. It's 5 billion people. They are still growing. I've been there to Asia. And when you see what's going on, then, okay, this is something and will keep being that way for the next 10, 20 years, which also means that for us in the developed countries, the old countries like the state, that means also more competition for copper, for all these metals, for commodities, for food and things like that. So you don't have to go there to invest. But if you invest, I don't know, in commodity business or food businesses locally, those will also benefit from those good global long-term structural trends.
Is there anything on the horizon for the global economy that has you worried, that has you sort of really avoiding certain areas? Where do you see risk most concentrated?
I see risks, I think, everywhere you can see risks. The government deficits and budget deficits in Europe and in the States are completely unsustainable, which means they will print money to get out of that. If they print money, our currencies will lose their strength and power. Therefore, we have to be in businesses that will do well no matter what happens with the currency. Then we have a lot of risk, I think, in private equity, because they are borrowing at 3%, investing in businesses at 4%. If, given the budget deficits and the US government needs to refinance 9 trillion in the next 12 months, and you cannot refinance that with a low interest rate. So that will also might be an issue that will not be discussed now, but maybe arise in April of next year and things like that. And then the house of cards might start to fall and then perhaps have systemic consequences. Buffett is not for nothing all in cash.
Yeah. And did you feel like your portfolio can withstand that? Or are you also expecting to experience a downdraft if you're not in cash? Do you have,
as I said, if there is turmoil, market makers, things like that should do much better. I think.
So that's your hedge.
Yeah, I'm hedged. Their earnings were 5 times higher in 2020 when there was volatility than in 2023 or 2024. So if there is volatility, I'm hedged there. I get my dividend.
Do you have a favorite? Do you think someone's best in class there?
Yes, but I will not mention names. And
Fair enough.
if I have a dividend yield on food stocks of 6, 7%, 8%, something from Asia, then I can use that cash flow and buy things on the cheap if and when the turmoil happens. If not, if nothing happens and we all keep on enjoying our lives as we have been doing for the last 15 years, then I'm also okay. I'll get my 5% dividend and slowly wait for better value investing times.
Mm. You've mentioned food a few times. Are you also looking at other commodities?
I am following all the commodities. I follow from coal, from copper, things like that. And there is significant volatility. So, I don't know, in April, some of those names were cheap. For example, like Glencore. Now it is already a little bit higher. So I'm always looking at that short term and also long term volatility. But in general, looking at the long term, copper players should do okay.
Mm. So if we think about we just talked about the risks, and it's very easy, I think, in this environment to be overly negative. What do you think the best opportunities are? How are you thinking sort of in a positive way about what the next few months might hold?
So the opportunities are perhaps, it's everything is cyclical. We had the last time I was talking to Anthony Scaramucci, we were discussing Archer Daniel Midland as a cheap stock. That was somewhere in March. And the stock price was 40. Now it is above 60. So every stock in a year usually drops 30% for whatever reason, and then it goes up 50% for whatever reason. If you look at, let's say, individual businesses. So you can always just wait for what you like to fall into your basket and then buy as much as you feel fits your portfolio. But in general, if you say now, what are the opportunities now at this moment, apart from the two I already mentioned, without taking too much risk, it is very hard to find. There are still some cheap stocks in Asia, but then you really need to know what you're doing or to, let's say, manage your exposure. Automotive companies are getting cheaper, chemicals are getting cheaper, and there are these sectors, but these sectors are not cheap yet enough. These are cyclical, then you need a recession, and then you go look into those.
I understand from the way you're talking about it, and again, I think this is interesting that something doesn't just sort of pop out of nowhere. You have a watch list that you're always adding to and subtracting to, and then you look for the price entry, but they're already on your radar. You're just looking for an opportunity to buy them. How often or how long do you hold them? Do you have a typical time frame? Do you also have a price target once they reach the upper end of that, then you're moving them off the list or you're taking your profits? Are you actively changing your portfolio quite frequently in this environment?
You always compare with the fundamentals. For example, the most recent sale I made was Alibaba. I had a significant position accumulated over the last few years when it was cheap. And now it has doubled even more from that position building. But I was looking at the fundamentals, and the fundamentals haven't moved. It's still the same business, slow growing, and it's all lying on promises on AI. And they have actually lowered their cash flows, promising investments in AI. And then I say, okay, it's time to it's China. Now everybody is excited about China. 2 years ago, everyone was saying China is uninvestable. For me, the risks of China are still there. Nothing has changed. So I say, okay, let's trim that position. So it depends on how the fundamentals move in relation to price. If the fundamentals keep improving, the price keeps going higher. As Buffett says, my preferred holding time is forever.
Yeah, exactly. I was wondering about that because I tend to think of value investing with a much longer time frame, but you sound like you're active and rebalancing and looking at market conditions all of the time. So it sounds like a little bit of a hybrid. Do you
Yeah.
own any growth in tech at all?
Do I own any growth?
Like, do you own
And
any AI exposed companies?
no, I did own Alibaba before it became AI exposed company.
So how do you stay patient and focused on value when we've clearly seen the market reward these tech companies and momentum companies, and they've shown sort of extraordinary numbers?
I think the essence of value investing is not outperforming. It's focusing on just performing. I have my goals. I have to reach my financial goals, slow and steady. I accumulate my dividends. I look at the fundamentals, and slow and steady, I keep on compounding no matter what the market does. I'm happy for everyone making their millions on AI stocks or Bitcoin or whatever. I'm happy for them, but I know I'll miss out on most of that party, and I'm fine with that too. I hope they are happy for me just doing my thing.
Yeah. Is there anything that you have felt like you were wrong about, or an area that you won't touch based on something that has happened or you feel maybe has changed in the investment environment? Are there no-go areas for you?
So I really am looking at, especially what you mentioned earlier, international investing. And with the current situation, I'm, let's say, going back home, Europe, US, and really watching those international investments and the risks there. For example, when I mentioned copper earlier, you look at the world and copper, it's extremely difficult to find individual copper players that don't have international risks. Or if there is a change, if politics in Chile, you can lose 50% tomorrow if they raise taxes or confiscate or things like that. And for example, that's an interesting way to play copper, which long term should be positive, is just to buy an ETF. If something happens in Indonesia, and copper prices go up, that business goes down, but everybody else gains on higher prices. So that is one of the few ways where I would play something even with an ETF.
Yeah, that comes up with commodities a lot because they're so very specific and
Yeah,
have
yeah, yeah, yeah.
that
And
international risk.
when you have these risks that you simply cannot know, you cannot estimate, you cannot know. If Indonesia, as they did 5 times already, say, okay, now this mine is from the government, you can just say goodbye to your money. Has happened, will happen again. So those are things that one should watch.
Mm. What is one piece of advice you'd give investors right now?
One piece of advice: to check whether the risk of the current portfolio is something that would impact their life. For example, if I could say the S&P 500 is overvalued, if next year we have a recession, if AI, which is my biggest concern, isn't as profitable as people expect, because Chinese AI is as good as American AI for a much lower price. So 2 years, everyone invested billions, and then you can buy cheaper somewhere else, as with his manufacturing, with everything. If that doesn't work out, we can look at losses of 50-60% with all these tech names, which would just mean that those revert to where those were in 2023. And if that would affect your personal well-being and lifestyle, then you have to consider the risks. And if
That's
you are into that, just hedge yourself. I think you can buy for 5% of your portfolio, you can buy a put on the S&P 500, and you can't lose money. If the S&P 500 goes up 20% next year, you will not make 20, you will make 15 because you spent 5% on the put, but you can sleep well. So be hedged is my message.
Great advice. I just want to ask you, you brought up a really important point, and I wonder if you're plugging this into your thinking. There are some who, the big conversation around AI is, well, it has no moat. Like, we know it's going to change everything, but we're not sure the companies who have it currently can gatekeep it and profit off it. But there's a possibility that all these, once it's out really being used in the ecosystem, that all these boring companies that you talk about will be the ones who benefit from it, and will be able, it'll hit their bottom line because they'll be optimizing it. Are you looking at that benefit of AI down the road? And is that something, when you're looking at companies, to see whether they're able to benefit from the efficiency of AI?
Every company that's now printing money, those are all benefiting from the companies that built the internet.
Mm.
Amazon, Facebook, Google, they didn't build the internet. Those have been asset-light businesses that have taken advantage of the companies building the internet. And AI will change the world. I'm using it. It's really remarkable. It replaces 10 researchers for me. It's not correct when I ask questions. I still have to recheck, and sometimes it's dead wrong, but it helps truly. However, with all these CapEx investments, it's very likely that the real winners will be those companies that are using AI. And there are many investors in the infrastructure, which means that we as customers, we will be able to choose. If we can choose, it means prices are lower, the investors don't make any money, the customer is the winner. I think also Jeff Bezos said that a lot of money is now thrown into AI, both at good things and at bad things, and that the customer will win. So it will be a great benefit for humanity, I hope, but it's unlikely it will lead to profits due to incredible competition.
Yeah. Great stuff. Sven, thank you so much. This was, I think, a really timely conversation. As I said, a lot of people have moved away from value investing, and this is a good reminder of the benefits and why people should, take a look at it and see if it's the right fit for them. So thank you so much. Really enjoyed it.
Thank you for having me.
And remember, if you'd like to check on the allocation mix in your portfolio and the risk, as we've been discussing, you can get a free review from one of the advisors in the Wealthion network by clicking the link in the description or heading to wealthion.com/free. Thanks for watching, everybody. We'll see you again next time.